Welcome to The Explainer. Look, today we're tackling one of the absolute most high-stakes dilemmas you'll face in the real estate investment lifecycle. If you've been watching the markets lately, you know that shifting interest rates have literally fundamentally changed the math. Properties that looked like absolute home runs, say, 2 years ago? Yeah, they're suddenly squeezing margins. It's forcing operators to make a genuinely tough call. Do you pour more money in to protect your position, or do you just cut the cord?
This right here, this is the ultimate fork in the road. Capital call or mid-cycle exit. Are we playing defense or are we playing offense? Basically, every single investor eventually stands at this exact crossroads, and the choice you make right here is going to dictate the trajectory of your entire portfolio. Okay, let's dive into this.
So here is our roadmap for today. Number 1, the real estate inflection point. 2, defense, meaning the capital call. 3, offense, recycling your capital. 4, the stay versus go matrix. And finally, number 5, the bottom line logic.
All right, let's kick things off with part 1, the real estate inflection point.
You know, a shifting interest rate environment doesn't just bump up your monthly payments. It forces you to aggressively evaluate your positions based on this core equation. Every single decision weighs the opportunity cost of holding your current equity against the projected yield of a new acquisition. Basically, if you leave your money where it is, what are you missing out on? And if you move it, what do you realistically gain?
Moving right along to Section 2, Defense, the capital call.
Now, what's really interesting here is that when the math gets tight, making a capital call is essentially a defensive maneuver. We call it right-sizing. But listen, you definitely shouldn't just throw good money after bad. A capital call really only makes strategic sense if it triggers one of 3 things: basis preservation, creating a refinance bridge to kind of wait out those bad rates, or capturing operational upside. Let's break these down, starting with preserving your basis.
So basis preservation makes a ton of sense when adding capital significantly lowers your break-even point in a high-growth area. Think about path of progress markets. Our source material points to places like Columbus or suburban Cincinnati as prime examples. If your asset is sitting in a market where long-term appreciation is, highly probable, then injecting cash to secure that property through a rough patch, that actively protects your long-term payoff. You're basically defending your territory in a highly valuable location.
But what about operational upside? Well, if you have a fully stabilized asset that's just bleeding cash because of debt, doing a capital call might literally just be plugging a sinking ship. Not great. But let's say you're halfway through a complex value-add project, like a 50% completed hotel-to-housing conversion. The whole scenario completely changes. The property hasn't reached its full potential yet. The meat is still on the bone, right? In this specific case, right-sizing protects the massive amount of work and capital you've already put in, allowing you to actually see that business plan through to its operational upside.
All right, let's flip it. Section 3, offense, recycling your capital.
I really want you to completely reframe how you think about an exit. Look, taking a loss feels bad, I get it. But it can actually be an aggressive sprint toward better opportunities, especially if you're facing this totally toxic financial state, negative leverage. This is when your debt service consistently outpaces your net operating income growth. It is a mathematical trap. Pouring more money into this offers almost zero improvement to your actual cash-on-cash returns. And this brilliantly illustrates exactly why taking the exit is playing offense. Volatility creates distressed opportunities. If you stay in your poorly leveraged deal, you might just be staring at a really stagnant 1.2 times equity multiple. But if you take your equity out, even if you take a slight haircut on it, and recycle those dollars into today's market premium, you could genuinely be looking at a 2 to 3 times multiple on a completely fresh asset. That's a huge difference.
Now, the timeline for that kind of leap, we're typically looking at the next 5 years. So you have to ask yourself, over the next 5 years, is my money going to work harder trapped in my current stressed asset or completely recycled into a fresh, distressed acquisition that I can buy at a steep discount right now?
And beyond all the math, there's a very real human element here. Management exhaustion. Let's be completely honest with ourselves. Stressed assets don't just drain your capital, they drain your soul. They require this disproportionate amount of mental bandwidth. Sometimes the smartest possible reason to exit is literally just to free up your own energy for high-conversion consulting, or, hunting down new, highly profitable acquisitions.
Let's move to Section 4, the stay versus go matrix.
Okay, let's see how this builds by bringing both the defensive and offensive paths together into a concrete framework. First up, asset quality.
If you have a Class A property in an irreplaceable location, you stay and defend. Class C commodity, you recycle. Rent growth, if it's outpacing inflation, you stay. Flat or declining, you exit. Debt, if new debt is actually cheaper, you right-size. But if it's competitive for fresh acquisitions, you lean toward exiting. If your alternative options are sparse, hold. But if you have a strong pipeline of distressed assets ready to go, play offense. Finally, tax implications. If you can seamlessly use a 1031 exchange to defer those hits, recycling suddenly becomes incredibly attractive. Which brings us to Section 5, the bottom line logic.
All right, it's time for the final evaluation. Here's the stark reality. If you choose to do a capital call, you're essentially doubling down on your original investment thesis. You have to be deeply, deeply honest with yourself here. Was that thesis built on 2021 pricing and debt? Because if it was, that structure might be fundamentally broken today. And defending a broken thesis, that is exactly how you lose wealth.
So, the absolutely crucial point here is knowing exactly what kind of asset you actually hold. If your asset is something like a national historic landmark or a core piece of a niche portfolio with incredibly high barriers to entry, then protecting that equity is almost always the wiser move. It's irreplaceable. But if your asset is just a standard hospitality or retail play that's been totally overtaken by macroeconomic market shifts, then holding on is just stubbornness. At the end of the day, it's a commodity, and commodities can be replaced.
For those standard commodity assets, taking the haircut right now is very often the most logical path to long-term wealth restoration. You take the loss, extract whatever equity's left, and you pivot. You go chase that target 15 to 20% internal rate of return elsewhere in a distressed market where your fresh capital suddenly has incredible purchasing power.
As we wrap up this explainer, I want to leave you with one direct, thought-provoking question to apply to your own portfolio today. Try to take the emotion out of the deal and just look at the facts. Which specific asset class or submarket is this deal currently sitting in? Because your answer to that question, whether it's an irreplaceable gem in the path of progress or just a stagnant commodity in a flat market, will tell you exactly whether it's time to answer the capital call or make your mid-cycle exit. Thanks so much for joining me, and happy investing.